Ladies and gentlemen of the rational crypto space. Rational because it's a very small group of people. Today's Monday, June 27th at 11:36 a.m. I think this is a very important conversation. This is something we've talked about for years, but this is also something that isn't talked about the way I talk about it. And every stream that we do is an iteration on all previous content. This stream is going to have an idea or phrases and words that attempts to organize and concentrate and coalesce all the shit that we've talked about over the last 2+ years. And we'll see it in the charts. It's more obvious than ever. And it's just a realization of what we've been doing for the last was 2008, 14 years, and even earlier. I'm not old enough to remember earlier markets. Uh, I wasn't too mentally aware back in 2000. I wasn't exposed to the markets. I do remember '08. I was getting exposed to it back then, but I surely don't remember earlier episodes. I was I was like 4 years old in '87. So everything is sped up. The cycles have sped up, and everything has changed. The structure of the system has changed post '08. So really what I understand is post '08 and the cycles that have been occurring since then, and I understand the stories that folks have told of older cycles. And the biggest thing that I take from the stories of previous cycles to the more recent cycles is the period and how much faster they are and how they compare, why they're faster, and the notion of intervention and the degree of intervention, and the reality that resonance is very much in play. The resonance is extraordinary. The highs are higher and the lows are lower. The volatility is at an extreme. So these are massive waves to be riding. These are 100-foot waves nowadays. These are, 10, 15-foot moguls, if you want the ski slope analogy. So we're going to pop over to the main screen and we'll see the extreme volatility. Everyone is excited. Maybe we had a bottom at $3 on like a convex, but the overall market is bearish. If it can be sold, it will be sold. There's not enough new capital. There's not enough fresh liquidity coming into the system to push asset prices up consistently. So what happens the difference between the current price and a run up starts to slow down with decreasing strength to the upside, it rolls over. And this is the typical presentation in a bear market, where, everyone thinks it's going to reverse to the upside and then it completely rolls over. Why? Because people want to protect their cash. This is a cash investor's environment. So we can look at charts, all the charts, we'll see the exact same phenomena. And there's no point in having hope. You don't have hope. Hope doesn't get you anywhere with regard to investing, which is why we don't talk about hope on this damn stream. What we talk about is protecting capital and this very high level narrative I want to talk about today. So I talk a lot about measuring from the bottom. Everyone talks about zooming out, but I want to present a different type of zooming out. Measure, so if you measure from the bottom, take a look at your wealth, dollar denominated, how many dollars you have, whether it's either the dollar valuation of assets or literally just cash or stable coins, and measure from January 1st. Do you have more year over year? If you do, you've made the right choices. And I'd like to help folks deal with the emotional insanity of the irrational exuberance. Block out your highs. Don't don't feel too bad about these highs. Everyone got caught up in the highs. Everyone gets caught up in the highs. You had $1 million and now it's down to 50 grand or 100 grand. You're down 90% of the money. Don't get caught up in the highs. The learning lesson from the highs is exactly what we're talking about today. The cycles and the reality that these cycles exist, and they give the money and they take the money, and the next time you trim more, You have to trim more. And it's about cash as the liquidity drains from the system. And the liquidity is very much drained from the system. And Emil and Jeff, and they're talking about it very, very well, and how we're on the tipping point. It's getting scary. The manufacturer indexes, the ISM, so on and so forth. These things are coming down very, very ferociously. There's a massive contraction in demand. So what'll happen is the demand destruction, exactly what the Fed wants, but it's going to overshoot because it's resonating. The lows are going to be lower. It's going to be such an incredible deflationary force. There's going to be such a demand destruction, and it's going to be more than they're anticipating. And what's stark and the structural change that's occurring is that demand destruction occurred with the Fed FFR, the Fed funds rate hikes that they've done, which are relatively trivial in historic terms. So they're able to tighten less and less. So the market has been basically tightening by itself. And that's why we're seeing this market behavior. So what does it mean how the cycles work and how to ride the waves? Measure from the bottom. Do you have more capital year over year? Carve out more at the top. Great. That doesn't help too much now. But cash is the best investment right now. So what does that leave us to on a daily basis? Thinking about, do we buy something? Do we sell something? You need enough cash to get through this painful time, which means as your portfolio gets larger, you could actually start treating it as a bank account. And a lot of the story I tell is how I manage my capital. I think of the cash that I carved out from asset sales as the cash that I can spend to cover my bills on a monthly basis. And a very important measure, which most persons neglect with regard to capital management, is how many months worth of cash do you have on hand? How many months, if you lost your job, if you lost your income, how many months worth of cash do you have to pay all of your bills, such that it's hard times, you're searching for a job, but you could pay all your bills at the end of the month? That is a great measure of how much cash you carved out, and if you carved out enough cash to get through the insanity of these resonating market cycles. There will become a point in time where the system deflates so ferociously, it won't necessarily be a market capitulation event, but the data that they'll see at the federal level, at the Fed level, will indicate that they need to reverse on policy, that the system is contracting too much, and they need to loosen, they need to drop the Fed funds rate, they need to increase QE, and they need to scream at Congress to spend some fiscal in order to prevent excessive defaults. And as Luke says, excessive defaults likely at the sovereign level, or at least the sovereigns level across the world. And they want to prevent the cascade of defaults from wiping out the grossly inflated system. So the riding of the waves, where are we in the wave? Hopefully, towards the beginning of the year, folks carved out enough cash to traverse this incredible crash of the wave. So right now, the wave is coming down, it's flatlining, and the wave is going to start building as the Fed realizes the horrible condition of the economy and they start to loosen conditions. And that's when free money comes into the picture. When they start juicing the economy, all asset prices start inflating again. And that's the free money period. So, what are the cycles? The cycles are a free money period, which is periodic, when they juice the market and everything goes completely vertical. So, let's look at free money period for Bitcoin. And that's very obvious. Brush. Look, free money period. That's your free money period. I mean, that's on the monthly, month after month for 1, 2, 3, 4, 5, 6 months. It was straight up 6 months out of a year. That's a massive amount of time. And this free money period's on all charts where you could just have something and it just goes up, up, and up. And you should be selling on the way up. So there's the free money period. This was, and was that December 20 where it started ripping? I guess this was January 21, and it started ripping. And then you had the decline and then the rebound. So the free money period will come. So the point is, you're not going to be able to buy the lows. So what do you do? What do you do? You carved out enough cash and you nibble a little bit. You can't go into your monthly overhead obligations too much, meaning you can't spend too much cash. And when I say nibbling, you're not taking a position. You're not taking 20% of a portfolio, not even 5% of a portfolio. You're just nibbling a little bit because you're trying to get a taste of how these protocols work. Maybe you're in an educational phase of your journey into capital management and investing. So you buy, $50, $100, 0.01% of a portfolio, fraction of a percent, just little nibbles here and there. It's like, for instance, I did a little nibble. The only nibble I've taken in the last 2+ months is this aura position, and it's a microscopic piece of the portfolio. It's very, very tiny, and it's no way, shape, or form expected to outperform, to make a huge amount of money. It's never gonna recoup any of the losses I have from all-time highs. But what will happen is when the liquidity re-enters the system, these types of positions, if they survive, and this is likely to survive, this is brand new, and it has contextual overtones to the curve federation. Point being, it will inflate, it will expand, it will be productive. But we should also expect further downside. And that's the whole point. Look at that, 20% down. This is not a bull market. Not a bull market. But you could buy at lows. Like you can nibble. I'll probably nibble on a little bit of curve at around 60 cents. Do we get lower lows? No, I hope not. But it's not impossible. Could have a capitulation wick, maybe 40 cents to 50 cents. It'd be nice if the capitulation wick or whatever happens to the downside is higher than the lows in November of 2020. But I'll be nibbling. You nibble, but the nibbles are very small. You know how I always talked about 1% of the portfolio to 10% of the portfolio changes everything? That's not this market necessarily. Yeah, I wouldn't even carve out a 1% position. You're nibbling just because you need to remind yourself that even in these conditions, buying is the right thing to do. But it's the position size that hurts people and the expectation that hurts people. Let's look at the convex chart for that expectation. People saw the bottom bounce. That this is a big dip, and they kept buying up here at 519, 430. That's a big dip on $5.25 to 420. That's $1 off. That's 20 something percent. That's painful, especially for smaller portfolios and persons just getting accustomed to the extreme volatility in these markets. But you could, if you nibbled point 0, if you have a $10,000 portfolio and you nibbled $50, if you nibbled $50, it's not painful, but you still had the experience of a buy and an experience of adding to your assets and adding to the right assets. These are the right assets, and vote locking it and participating in the biweekly vote and getting 50 cents revenue, because then you see the behavior of these assets and how powerful they are, and you can't do that unless you nibbled a $50 position. So this is a time for nibbling. This is a time for information asymmetry. This is a time for understanding the way the protocols work and seeing maybe if something new could come out. The bear market is for building, and this is a heck of a production. But this is not a time. This is aura, by the way, and this is a catastrophe for someone's portfolio. 218 to a $1.23. Look, someone carved out a big position to get it up to 218. And they're down almost 50% on the portfolio, on the position. That's horrible. It's painful to see. But if you nibble 0.01% just to get a taste, not painful at all. And it was a good experience because you were able to figure out that you had to self-delegate. I didn't do that shit. Then you're able to go over to hidden hand and you're able to see what kind of bribes. And the fact that there is bribes, that's pretty incredible, by the way, guys. The fact that there's any bribes off the bat, that's actually quite interesting. because there's basically no bribes going around on the other hidden hand implementations. Maybe a little bit, but look, balancer. Look at the balancer bribes. And it takes a large amount of bow to get a decent part of the revenue, but it'll be nice in the next bull market if you see these bribes at 200 grand or 2 mil, because Frax has been throwing around a couple of mil, especially during the bull market, and it's still over a mil on their bribes. If you go over to Vodium, you'll see their bribes on VLCVX. So do we not expect other protocols that make money, that are cash flow positive, to bribe, to incentivize voting? Of course, we should. So nibble, nibble, nibble. Don't expose yourself too much. Make sure you have enough cash. Cash is going to outperform the most. And it's going to continue. There is no bottom. You got to understand there's no bottom at all on the horizon right now that is going to be prolonged. Why? Because how do you bottom? In pre-08, you bottom when the debt defaults collapse. You have the bankruptcy wave that takes out the fluff of the system. You have the restructuring, then you have the capital investment into manufacturing and corporate growth. It's not buybacks, that's a bunch of fucking bullshit. But it's investment in productivity. And right now, there's less and less productivity. And we have the horrible supply chain issue and war looming above all else. All we see on the horizon is contraction and deflation. So unless you see like $1 trillion investment in domestic manufacturing or something that's going to produce a huge amount of resources and productivity to refine and manage and manufacture those resources, there's no bottom in this shit. This thing is a black hole. But I find it very interesting that I know that, but I also know this is where you have your capital, a large part of it, because the market will turn, and it's probably going to turn for artificial reasons. So where's the bottom? The bottom is probably intervention, where they see all this contraction. It finally shows up on the data. The manufacturing orders, 20% drop, finally show up in the data that the Fed looks at. And they capitulate on their narrative that they have to fight inflation. But the amount of demand destruction required for them to deal with this inflationary pressure, it'll put so many people out of work. What is it, the Phillips curve? It'll be so bad, even in traditional terms. So, they got that. We all know the catch-22 that the Fed is in. It's horrible. It's either an economy at all, whether this thing completely has a deflationary wave that wipes out everything, or inflation, because they're not going to be able to reduce demand. There's too many people on the damn planet. George Gammon talks about the elites and how they want to reduce the birth rate. There's too many fucking people. There's too many people. It's not about excess currency. Folks are getting it wrong. I'm sure. Maybe. What does that mean? If there's excess currency, that means folks have too much money. That means they need to be poorer. They need to have less money. and no, and that's not good. And then you can't get into the conversation of disparity where there's a concentration of capital with the wealthy, but even they're getting poorer. Everyone's getting poorer right now. Too many dollars chasing too few goods. But what happens if the too few goods completely collapses? And that's really what's going on in the market. That's what 2020 was. Without the globalized supply chain, which has basically been attacked and is collapsing, there's going to be a significant disruption to supply. So the inflation, consumer price inflation, is overwhelmingly because of supply disruption, supply side inflation. This isn't, it'd be immoral to say this is a demand inflation. Yeah, obviously demand is it's scary with regard to luxury goods. That's just people being stupid. But supply side and demand side inflation with regard to consumer staples, food. Are people buying more and more food? No, they're buying the food they need to eat. So I'm very much angry, and I don't like the narrative of trying to collapse demand to cure consumer price inflation. I don't like that at all. That's not humanitarian. There's something wrong with that. But that's the only tool. Fuckers talk about tools. That's the only tool they have. So the appropriate solution to consumer price inflation is getting supply online and curing malinvestment, where there's no investment in farming and manufacturing and domestic resource production. They've attacked the problem with the wrong solution because that's their only tool in the toolbox. Every time they say tools, it drives me nuts. They don't have tools. They have tools, singular. Tool, not plural. All right, let's take a look at one thing. We'll take a look at bonds. And, we're just such an incredible structural change of the global financial system. Bonds are not ripping. Equities have risked off. Crypto has risked off. And it's Japan in most regards. Japan with their yield curve control. They're selling everything. They're selling the treasuries. Everyone's selling the damn treasuries because they need to raise the cash. So what do we do in this market? We do the exact same thing that everyone else, the countries are doing. We raise the cash. And once all this deflation, this deflationary impulse is artificially corrected, we'll have the cash and we could buy. Hope that helps. It's not the easiest story to tell. And I don't know if it really, it should help ride the wave, because if you're not buying things and you have cash, it means once they finally capitulate and start to turn on easy money mode, let's look at the Bitcoin chart for easy money mode, then you have the cash. So don't buy big positions. Expect further depreciation. Nibble on shit because you want to explore and you want to understand and you want exposure to information asymmetry, such that when easy money is enabled, bam, you drop 30% of the portfolio into Bitcoin and you rip 5x on the money. You sell it and then you're able to diversify into yield-bearing positions, and now you structure a portfolio. But the only way you're going to do that is if you have the cash and you're only nibbling, and you also have to nibble, because when you rip a 5x on Bitcoin in easy money mode and you sell and you're not near the top, 5x is probably 20, well, 5x is probably 15 grand from March 2020 lows. That is a 5x. It was 3 and change down at the low. So you sold here and you diversified into various yield producing assets. The only way you're going to know what yield producing assets have survivability factors, have cash flow positive balance sheets, and are likely speculatively meaningful systemic infrastructure, is if you nibble. But if you nibble too much, you're going to be destructive to the portfolio. Don't destroy the portfolio. This is a market that will take everything from you. This is a market where if it can be sold, it will be sold. How many folks, there's probably at least one person, 41 people in the stream, 10 likes, that probably carved out a decent CVX position. This is painful to experience. But if you bought $100 out of a $10,000 portfolio just to experience it, it's not that painful. Nibble, experience, get that information asymmetry, because easy money mode will return. But this is not easy money mode right now at all. Let's hit some comments and help you guys out. Raul's in the house. Crypto Jake, Risky Crypto, Asun, Mix, One Curious View. Yeah, gas prices are crazy. So how do you handle high gas prices? You need cash and drive less. So you're going to destroy your demand a little bit, and hopefully as much as you can. But now you can't invest. You can invest less. So carve out less and focus on the education experience and be prepared. This is a time to get prepared for the easy money mode. What do you mean with the war? Current Ukraine, Russia, or is direct conflict between other nations? Well, this isn't a war between Ukraine and Russia. This is a war between the UN and Russia, which means it's a war between the US and Russia. I said from the beginning this was a world war. It is. So just that's not just my opinion. I think it's just obvious. Look at everything we're sending to Ukraine. It's a proxy in all regards, and look at look at all the sanctions. Why are we sanctioning Russia between a war between Russia and Ukraine? Why are we in there? We're in there because it's a world war, because it's all related. It's all related with regard to supply chains. It's all related with regard to the global financial system. It's all related with regard to the U.S. disseminating its treasuries and the rest of the world having to buy them to finance all the shit that we've done in the U.S. over the last, what, 40 years since 50 years since we came off the gold standard. Very much of a world war. It's not too hot. The hotness is concentrated in the Ukraine territory, but it's everyone's involved. Therefore, if it's everyone's involved in this war, it's a world war. It's just not violent in every country that's involved in the war. To be honest, I also think that the worst thing among the current ones, inflation, supply bottlenecks. Well, yeah, but it's more bigger story than just those words, inflation, because bear in mind we're an extraordinary currency disinflation, and right now deflation, because the bankruptcies are capital destructive and the defaults, it's all destroys capital, so it's a deflation. So it's not as simple as those words. Those words are very misleading in the way they're applied. Peter, I almost destroyed the portfolio. No, no. I hope not recently. I hope not recently, my friend. You managed to survive. This is all about survival right now. So to be wiser in the next cycle. So there is you buy, but you have to buy such small portfolio positions because the only purpose of the buy is education. Is to be prepared for easy money mode. Protect the dollars. The dollars will be your most outperforming and most useful investment right now because you could go into any store and they'll all accept dollars. They're not going to accept treasuries. They're not going to accept CRV, CVX. They're not going to accept it, but they'll accept the dollars. So that's the best investment right now. So you'll do better next time. And the fact that he didn't get destroyed is a good thing. Do better next time. Not an option. We have to. We all can do better. Always good to catch you live. Appreciate it, Vetso. Always pleasure. What's your confidence in FRX holding peg? FXS, he probably Frax. I think there's risk in everything, meaning it's all odds. I think they're in a great position to survive. It's all about survival. And what survives becomes infrastructure, so on and so forth. So you have to follow more on their Telegram. They don't have Discord, but they own the liquidity. So Frax has a very powerful capacity to maintain the peg in almost all market conditions. And the fact that they survived UST collapse is extraordinary because they were paired with UST very deeply. And but Frax is heading in the right direction with the base pool on curve, with the amount of revenue that their treasury makes. They're pulling in what, $60 to $80 million a year in revenue. So it's a cash flow positive system that's profound from a macroeconomic standpoint. So it's a great protocol. Don't expose excessively. This is not a time, as I've said, to take on large positions, but it's a time to nibble. A VEF, it's not very productive. So there's no bribes on hidden hand, unfortunately. So it's not that productive. But what is it? It's something that I think is a profound protocol, because I think one of the biggest stories, one of the biggest concepts and narratives in crypto is stablecoins. Predominantly because of how extraordinary disinflationary global currency supply is. So I think stablecoins play into the historic Eurodollar narrative and why Eurodollars became so meaningful in the expansion of global financials. and why there's way more euro dollars than there are dollars, and there's way more euro dollars than there are options and derivatives of dollar, even dollar denominated debt. It's multiples of euro dollars, 3, 4 times the amount of euro dollars than every dollar and dollar derivative there is out there. That's just how much currency has been needed globally to achieve what we've achieved thus far. So I think stablecoins are going to become a very big part of global financials because of their capacity to expand currency in a new way. Maybe it's an iteration of the historic eurodollar system, maybe a public facing eurodollar system, maybe a variety of things. But of all the stablecoin protocols, what catches my fancy the most? Definitely the CDPs, Qidao, Abracadabra, and MakerDAO are the historic CDPs, collateralized debt positions. But Frax is more. Of all the stablecoins out there, Frax is more than the CDPs because they have an active treasury that generates revenue. So it's also an enterprise that has cash flow positive balance sheet. It's very, very meaningful, and it catches my eye in that regard. Um, don't take positions, guys. When I talk positively about protocols, this is a time for information asymmetry. This isn't a time to figure out what positions to take now. This is a time to figure out what positions to take when easy money returns. And you might not get the multiples on Frax. It might not be there where you get the easy money. Maybe you get the easy money on something else. It's hard to choose. You might get the easy money on Bitcoin because it fits into the macro financial landscape currently. And then you get the multiples there, and then you're able to diversify into a select group of protocols that generate revenue. Maybe in the next bullish cycle, Frax is getting very meaningful incentivized votes. So then it becomes very productive. And then how does that compare to VLCVX or VECRV or VL Aura or VE-BAL or even VoteLock, the cheat out, because that's actually quite productive. Um, so it's hard to choose. But one thing I I know for certain, the vast majority of shit is literally shit. It's just shit coins. So I don't like when traditional financial folks say that word because it's very stereotypical. But when I say it, it's because I know the vast majority of stuff is crap, but I also know peering through the madness that there's an extraordinary landscape of viable cash flow positive protocols that have a high likelihood of survivability. What survives will become infrastructure. Um, Let me catch up with comments. Oh, there's a lot. What's your low price on Ethereum? Have you looked at GMX? I have not on either. I'm not too interested in lows. I don't really want to buy a low. I want to buy when things are easy money, and it's not easy money right now. GMX is cool, but I'm probably more interested in synthetics. Synthetics is historic, so GMX is great, and they've proven to be a very meaningful protocol. But synthetics has a much bigger history and a much bigger footprint across optimism. The biggest change this time was I had a significant position in cash. I'm actually enjoying the drawdown knowing I can buy at deep discount. Yeah, well done. Don't buy just because it's deep discount, though. People often see the cheaper prices and they're like, all right, I'm going to buy because it's a cheaper price. But if it's a bear market, it's going to keep going down. You're in a good position, but you have to wait for the capitulation. There is no more normal market cycle. There is no more bankruptcy wave, cures malinvestment. You get investment into mining and resource extraction and then manufacturing, and then you get a productivity boom, a business cycle. That doesn't exist anymore. All you have left is the rate cycle and the intervention cycle. So that's when there's bottom. When there's capitulation, when the Fed, as per like Olu Groman, when the Fed capitulates, realizing that if they don't do something, the deflationary wave is going to be cataclysmic and it's going to wipe out countries. Now, the U.S. doesn't really want countries to go under. So we have a responsibility to the rest of the world because we supply their currency. So we can't let countries go bankrupt and default on debt. So they'll capitulate. That's the cycle. And once you start to see the market go green after rate cuts and QE, and then you'll see the equities market start moving, then you can take a good position, and you don't have to go out on the curve. You'll get your multiples on Bitcoin. You get your multiples on Ethereum. That's it. And you get a 3, 4, 5x on 50% of the portfolio. Then you can diversify into revenue producing assets, and those will keep going up because it's easy money mode. And since it's easy money mode, the principal in those revenue producing assets is going up, but also the revenue is going up, and you're saving the revenue. Save the revenue, cash. Whatever you get in revenue, you keep it as cash, and then think of it as an income. Think of it as a salary at the end of the week and a paycheck. Biggest learning lesson from the last 2 years for myself. Um, Dan, would Frax still need to utilize CVX, increase gauge emissions if they have massive protocol and liquidity? Yes. Why? Because because it's something to buy. You see what I mean? Because they could do what they could do with their own holdings, but if there's still something to buy, they're probably going to do it. They should, because it's an opportunity to get more voting. So I still have I think everything is heading in the direction we're thinking it's heading. Bribes will go up, protocol and liquidity go up, the amount of curve in circulation will go down, more will be held in reserves, and it'll become a relatively scarcer asset over time, of which it's already a relatively scarce asset. People are hoarding the shit out of it. Thoughts on DGB? I started a lot of my crypto involvement with Digibyte. It's a wonderful protocol from a humanitarian perspective, noble, honorable, egalitarian, or good vibes, or systemic importance and meaning, UTXO, sovereign assets, where you own your. What's up with my bandwidth? My bandwidth dropped. My bandwidth is out. Bandwidth. I'm getting 0 kilobytes per second. Sorry, guys. I'm going to wrap up the stream. I'm going to verbalize it, even though it might not go through. It is what it is. Um, Fra- uh, Frax USDC, mostly working capital, is. I'm not too concerned on the Frax peg, honestly. Fran Corp, good evening. From out of balance tokenomics compared to Curve, I've had a chance to do a dive. Well, Curve, I'm not quite sure how to answer that question, my friend. Tokenomics is something to. Oh, balancers tokenomics. I didn't read it correctly. Oh, damn, the bandwidth is horrible. All right, maybe it's not. Betso still says it's still good. Okay. I'm getting thrown off because of the bandwidth meter. Um Balancers, it's earlier in its getting ground phase. So it's like Curve early on, except it's different because Curve started and Balancer started not too long after Curve. So, but Balancer finally has its convex reflexivity. So it's not something to think about which you should have a higher portfolio weighting in, because we really shouldn't have meaningful portfolio weighting in anything in this current market. And we don't know where Aura is heading. And we need other protocols to start accumulating VE-BAL and reserves. So it's very early. So anything you're thinking is probably heading down the road of a highly speculative train of thought. So please be very careful. Don't overweight positions and only nibble in this type of market. But It's the same thing. VE Bow and VL Aura and Aura Bow. It's doing the same thing that Convex did for Curve, Aura is doing for Balancer. So that's pretty cool. So I like what I see there, and that's why I nibble, just a little nibble on a little bit of a position. I don't expect significant gains at all. In fact, I expect further losses. Food for thought. Jake, I'm bad whiffing. CVX unlock incoming, sell or relock. I am leaning towards carving out a little bit of cash, bumping my VECRV position. But here's the thing that makes me think not to do that. VL CDX still is much more productive as compared to CRV. It's 7x more productive. Look, let's go over to Vodium, and then we'll go over to DeFi Llama. So Curve is cranking out less than a penny per VECRV, but Convex is still cranking out 6 and change cents. And then if we go over to price charts, so that's 12 times as much revenue, and the price is 75 cents compared to 4. So it's 5. So it actually is pretty comparable on a revenue per unit of asset uh, comparison. So that's pretty interesting. I don't know. I don't know. I don't have an answer on how to handle the VLCVX unlocking, but I'm tempted to carve out some cash, and I'm tempted to add to CRV. And I'm also tempted just to retain the VLCVX position because it is still productive. I'm tempted to do a lot of things. How we figure out what the optimal thing to do is you only know in hindsight. I hope that helps. All right, let's wrap up the stream. The bandwidth is absolutely horrible today. 33 people in the stream, 18 likes. I appreciate all of you. Monday, June 27th at 12:19 p.m. That's the name of the game. I'll see you guys on Wednesday. Thank you all for joining. Tell everyone to subscribe. As always, After Party is on Discord for the most rational community in the entire crypto space. I appreciate each and every one of you because I know together we can do better. I will see you on Wednesday. Peace now.